And today's video we're going to talk with you about 6 simple steps to invest in stock market. Follow these easy steps for avoiding any mistakes and earn as much as possible. Let's go back to the video. If you wish to start investing in the stock market, to possess a fair understanding of stocks and shares. Regular investment along with avoidable of financial risk can help you save a significant amount of money over a period of time. Following are a few tips that can help you, if you're beginners, save lots of money for the future. Number 1 is set your objectives. Setting long-term objectives can be a great benefit when investing in stock and shares. Whenever you wish to save for your own retirement or for your children's education expenses or to buy a property or any other reason, setting long-term goals will help you better understand the importance of saving. In case you wish to invest in a scheme or investment instrument for a short period of time and withdraw your funds after a few years, another investment instrument can be considered for investment as the volatility of the stock market offers no certainty on whenever or not you can access your fund when required. Your investment portfolio will grow based on factors such as the amount of capital invested, the tenure of the investment, and the net annual earnings on the capital. It's advised that you begin investing as early as possible, as it can help you save a significant amount of money. Level of risk. The level of risk associated with the investment option you choose must be carefully analyzed before you put your money into something. The best way to identify the risk associated with various products and identifying the best option is to conduct a comprehensive comparison between the different schemes. Doing so will enable you to figure out what level of risk each product holds, and you can invest your money accordingly. Understanding the level of risk involved with investment will help you avoid those instruments that have the potential to see you incur losses. Control over emotions. One of the primary requests in investment in the stock market involves controlling your emotions. The market segments toward a company becomes evident through the price of its shares. For instance, if most investors are skeptical about the prospects of a particular company, the prices of stocks and shares will reduce. Similarly, when investors show confidence in a particular company, the price of the stock and shares will increase. Investors who are positive about the market are called bulls, and negative counterparts are called bears. The change in price of shares is affected by the persistent conflict between the bears and bulls, and the short-term changes in prices and influenced by speculations and emotions instead of systematic analysis of the prospects, assets, and management of the company. As stock prices keep changing, investors start to feel insecurity and tension, creating questions like whether or not they should sell their stocks in order to avoid losses, or if they should retain the shares and hope for a rebound in prices. Since actions are primarily driven by emotion, it's essential to ensure that all factors are analyzed carefully before making a final decision. Study the stock market. Prior to making an investment, a beginner in the stock market is advanced to study the stock market for a basic, including the various securities that compose the market. The fields that must be focused on include order types, financial definitions, and metrics, various kinds of instrument accounts, timing of investment, methods of selecting stocks, and many else. Gaining a thorough understanding of the stock market will ensure that you are in a good position to assess risks and make a right decision. Diversification with investment. Diversification of stocks is mainly done by expert investors after all the research has been performed to classify and calculate the risk associated with the investment. However, beginners will have to gain some experience in the stock market before understanding the diversification of the investments. If you purchase stock from 5 different companies and expect the prices of each investment to grow continuously, there are be situations where 2 of the companies may have performed exceptionally, occurring at 25% increases in price. The shares of 2 other companies may have included by 10% each, and the shares of the 5th company were liquidated to clear a huge lawsuit. Since liquidation of shares results in a loss for the investor, diversification can help you recover that loss through profits from the other companies, thus making it better for the investor than it would have been if she avoidance of leverage. Leverage is when you borrow funds and use it to put your stock market plans into action. For margin accounts, brokerage firms and banks can grant loans to purchase stocks, generally 50% of the face value. So, in case an investor decides to purchase 100 shares for, let's say, 500 each, the total cost would be 50,000. The purchase can be completed by a loan of about 50%, 25,000, from a brokerage firm. Using borrowed funds has an effect on price change. For instance, if the price of each share increases to 1,000 per share and the investor decided to sell it, his or her return of investment will be 100%. If they had used their own funds 1 lakh minutes, 50,000 divided by 50,000 in case 25,000 was borrowed to purchase the stock, and if it was sold for 1,000 each, the returns will be 300%. 1 last minute 25,000 divided by 25,000 after the loan worth 25,000 was being cleared. The prospects are great when the price of shares increases. However, a decline in shares means that you will lose a good amount of money on your initial investment, in addition to the cost of interest payable to the broker. Following those simple tips will enable you to gain a good understanding of the stock market and invest your money into instruments that can help you make significant profits over a period of time. Thank you for watching, subscribe to my channel, and see you in next video. Bye.